Once the world's economic juggernaut, China is now slowing, and not just because of the West. Its real estate empire crumbling, youth unemployment surging, private enterprise gutted, foreign capital fleeing. And now, with the US dialing back on tariffs, one big question remains. Was America ever the real threat to China's economy? Or is Xi Jinping doing the damage from within? In a surprise move, the US and China have paused their trade war, agreeing to a 90-day tariff truce and cutting duties by 115 percentage points. That's a far cry from the tit-for-tat days of 145% US tariffs on Chinese goods, 125% Chinese tariffs plus rare earth export threats. But here is the twist. This isn't a win for China, because even before the ceasefire, the warning lights were flashing. Factory activity shrank at its fastest pace in over a year, which begs the question, does the US even need to pressure China anymore? Or is China already in slow motion collapse? China's fading glow. Remember when China was the engine of global growth? Those days are slipping. The economic model that lifted millions, low-cost labor, infrastructure mega projects, booming exports, now struggles under Xi Jinping's heavy-handed state control. So what's the reality behind China's current economic slowdown?
Now, there are problems in the economy, no doubt about it. Many of these problems have been around for quite some time. In fact, one can trace back imbalances in Chinese economy to what happened after global financial crisis, so 2008, 2009, when massive stimulus package was introduced. It was 4 trillion yuan, about 700 billion US dollar. That led to economic growth accelerating, coming back to double-digit growth rate. But it also led to overcapacities in many areas, and also imbalances became worse. There are some serious problems, including the fact that real estate, which accounted for 25 to 30% of GDP of China, and which accounted for very large segment of household savings. It has been going through a serious crisis since 2021. But at the same time, what has happened that new drivers of growth are being introduced, most important being innovation-led growth. And China has made very impressive gains in that area. In fact, it's acquiring a sort of dominant position there, but that has also led to overcapacities.
The data doesn't lie. China's official Q1 GDP growth 5.3%, but nominal GDP just 4.2%. That gap spells one word: deflation. Prices are falling for consumers and producers. Worse than a crash, this is a slow freeze, a gradual stalling of the economic engine. The real estate collapse. The fall of Evergrande wasn't just corporate failure, it was a structural breakdown. Real estate made up 30% of China's GDP. Then came Xi's 3 red lines policy to curb debt, and the entire sector panicked. Home sales down 20%. Construction sites stalled across cities. Prices falling for 2 straight years. Even Country Garden, once rock solid, is now wobbling. And that's not all. Demographic dilemma. Youth unemployment hit 21% before Beijing stopped publishing the number. Birth rates and marriages are falling. China's population is aging and shrinking. Without a young workforce, future growth isn't just slower, it's in reverse. Innovation under attack. China's crackdown on its own tech giants has sent a chilling message. Alibaba dismantled, Ant Group frozen, entrepreneurs vanishing, foreign investment at a 30-year low, and the stock market flatlined for 2 decades. Innovation needs freedom. Xi seems to prefer control. But what's fueling China's slowdown more? Xi's internal policies or global factors like US tariffs?
It's a more complex situation. For last 29 months, producer price index in China, in fact, has been in negative territory. China's economy is very close to deflation, which is a very serious situation. Yet, you have a complex situation, but it remains on the whole economy, which is not peaking, but it has serious problems, and to some extent, Xi Jinping's economic policy, which emphasizes state sector, which emphasizes industrial policy, is also creating certain imbalances. These headwinds in global trade will no doubt affect China. But let's see how it plays out.
Trade war, just a sideshow. So, all in all, the US China tariff truce may ease short term pressure, but China doesn't import enough US goods to hit back with equal force. And let's face it, this isn't really about Washington anymore. The big picture. So, China's most painful problems today are self inflicted: high debt, shrinking labor force, stagnant productivity, a clampdown on innovation, a leadership prioritizing ideology over economic reform. Xi Jinping envisions a strong, self reliant China. But the way he is going, he might just be weakening the very foundations of that dream. The world once feared a rising China. Today, it may need to prepare for something more unpredictable, a faltering China led by a government unwilling to course correct. So, what do you think? Is China's slowdown mostly Xi's own doing, or is the global squeeze still in play? Drop your take in the comments and don't forget to like, share and subscribe to Business Standard for more sharp, no-nonsense explainers on global economics and power shifts.